The great lie about getting rich is that you must begin with something dramatic, a brilliant business idea, a wealthy family, a lottery win, a six-figure salary, a perfect market entry, a secret investment only insiders know. That lie is very useful to people who do not want to begin. It gives them a respectable excuse. They can say, I would invest if I had more money. I would start if the market were safer. I would build wealth if I had a higher income. I would take control if the economy were clearer. I would become serious when life finally calms down. Life does not calm down first. You become serious first. That is the first uncomfortable truth of money. The mountain does not move closer because you wait at the bottom and complain about its height. You climb it one step at a time, and the first steps usually look too small to respect. $100 a month. That is the kind of number people dismiss. They say it is not enough. They say it will not change their life. They say they will start when they can invest $500 or $1,000 or $5,000. Then 20 years pass, and they still have not started. The tragedy is not that the first $100 was small. The tragedy is that the person never understood what small money can become when it is given time, consistency, and protection from panic. That is the first mechanism. I call it the small door principle. A small door is still a door. Most people stand outside wealth because they are waiting for a grand entrance. They imagine wealth as a massive gate that opens only when they have a large income, a large inheritance, or a dramatic opportunity. But wealth often begins through a small door, a monthly transfer, a low-cost index fund, a retirement account, an emergency fund, a decision not to spend the last bit of income on things that make life feel better for a week and leave nothing behind. The door is not impressive. That is why it works. If the door were impressive, everybody would walk through it and the advantage would disappear. The advantage is that most people are too impatient to respect boring beginnings. They want a transformation. Wealth usually begins as a habit. When I was young, I learned that small amounts of money behave differently depending on where you put them. If you spend them, they disappear. If you save them, they wait. If you invest them wisely and leave them alone, they begin hiring little workers of their own. Those workers are called returns. At first, they are tiny. Later, they become meaningful. Eventually, they may become more powerful than the original contribution. That is the miracle people call compounding. But compounding is not magic. It is obedience to time. The second mechanism is the safety net gate. Before a person invests seriously, he must understand what can force him to sell. Most beginners think the danger is picking the wrong fund. That is one danger, but it is not the first one. The first danger is having no buffer. If you lose your job, face a repair, receive a medical bill, or miss a paycheck, you may be forced to pull money out of your investments at exactly the wrong time. That is how people undo years of progress in one bad month. So the first layer is not glamorous. It is an emergency fund, a month of expenses, then 3 months, then 6 months. If your life requires it, the exact number depends on your job stability, family responsibilities, debt, health, and temperament, but the purpose is always the same. The emergency fund keeps your investment account from becoming a panic account. Investing without a safety net is like planting seeds in a field you may need to dig up next week. For food, the seed never gets a chance. A job loss can teach this lesson quickly. One day a person is working normally, the next day the company says the position is gone. No warning. No personal hatred, just business that moment changes how you see a paycheck. A paycheck is useful, but it is not a guarantee. It is a stream controlled by somebody else. S decision, somebody else S market, somebody else S budget, and sometimes somebody else S stake. A person who treats the paycheck as permanent is living with hidden fragility. An emergency fund is not wealth. It is the moat around the wealth you are trying to build. The third mechanism is the paycheck illusion. Most people believe they are safe because money arrives regularly. They build life around the assumption that next month's S income will look like last month. S income, rent, car payments, subscriptions, dinners, travel, clothing, phones, insurance, and debt payments all attach themselves to that paycheck. Then the paycheck disappears for a month or two, and the entire structure shakes. The danger was not created by the layoff. The layoff revealed it. That is why the first emotional transformation in money is not becoming rich. It is realizing that dependence on one income is risk. This realization does not require you to quit your job, hate your employer, or become an entrepreneur. It simply means the paycheck should no longer be the only pillar holding up your life. Your paycheck should fund a buffer, then it should fund assets, then those assets should slowly begin creating a second source of strength. The fourth mechanism is the first growth disappointment. When people finally begin investing, They expect to feel progress quickly. That expectation is dangerous because the first years often look unimpressive. If you invest $100 a month, after 2 years you have contributed $2,400. Even with a decent market return, the growth may be only a few $100s. That can feel disappointing. It feels like you did all the work because at the beginning the portfolio is too small for compounding to look powerful. The account is mostly contributions. The growth is tiny. The investor sees a small gain or sometimes a loss and thinks this is not worth it. That thought has destroyed more future wealth than most market crashes. The beginning of compounding always looks underwhelming. A baby tree does not provide shade. A young snowball does not crush anything. A small engine does not pull a train. But the fact that it is small does not mean it is failing. It means it is early. That is the fourth mechanism, the early years test. The market tests beginners in two ways. First, it tests whether they will keep investing when the gains are too small to impress them. Second, it tests whether they will sell when the portfolio temporarily falls below what they contributed. Many people fail both tests. They quit because progress feels slow, or they panic because volatility feels like proof they made a mistake. The market is not only a math machine, it is a temperament machine. It transfers money from people who need immediate emotional confirmation to people who can let a good process work without applause. The fifth mechanism is the contribution bridge. At first, your contributions matter more than returns. Later, returns begin to matter more than contributions. The bridge between those stages is built by repetition. A person investing $100 a month may not feel wealthy after 10 years. But something has changed. The account may contain far more than the money contributed. Investment growth begins to show itself. The machine is still small, but it is no longer invisible. After 30 or 40 years, the same monthly habit can create a result that looks impossible to the beginner, not because the contribution was large, because the contribution had decades to recruit time, reinvested growth, and compounding returns. The public loves sudden wealth because sudden wealth makes a better story. Patient wealth makes a better life. If you begin with $100 a month in your 20s and later raise the contribution as income rises, the machine changes dramatically. 100 becomes 300, 300 becomes 600, 600 becomes 800. The contributions grow with earning power, and the earlier dollars have already been working quietly in the background. That is how a normal person can build a large portfolio without ever feeling like he made one heroic financial sacrifice. He simply refused to stop. The sixth mechanism is the raise capture rule. When your income rises, your investments should rise before your lifestyle absorbs the entire increase. This is where many people lose the game. They get a promotion and immediately promote their spending. The nicer apartment, the better car, the better restaurants, the extra trips, the upgraded wardrobe, the more expensive habits. A raise arrives. And within a few months, the old pressure returns because the lifestyle grew to consume the new income. That is not progress. That is inflation of the self. The raise capture rule says every increase in income must be partially captured for wealth before it becomes comfort. You can improve your life. You should enjoy some progress. But if every raise becomes spending, you have only built a larger cage. A young person investing $100 a month is building the first track. A 30-year old increasing to 300 is widening the track. A 40-year old increasing to 600 is giving the train real speed. A 50-year old increasing to 800 or more is letting the machine roar during the final decades. The exact numbers do not matter as much as the principle. Your investment contribution should grow when your income grows. If it does not, lifestyle has captured your future. The seventh mechanism is the waiting trap. Many people know they should invest, but they say now is not a good time. Inflation is high. Interest rates are confusing. Politics are ugly. The market might crash. The economy may weaken. A war may expand. A recession may arrive. Stocks feel expensive. Stocks feel dangerous. Cash feels safer. Tomorrow feels easier. The problem is that tomorrow has said the same thing for generations. There was always a reason not to invest. There was a reason in 2008. There was a reason in 2020. There was a reason during inflation scares. There was a reason during elections. There was a reason during wars. There was a reason during rate hikes and rate cuts. The person who waits for the world to feel safe usually buys after the market has already recovered. He pays a higher price for emotional comfort. The investor who accepts uncertainty as permanent begins earlier and lets time absorb many of the short-term mistakes. This is why time in the market usually beats timing the market for ordinary people. Not because timing never matters. It matters, but because most people are bad at it, and the cost of waiting can be larger than the cost of imperfection. The eighth mechanism is the perfect entry mirage. A perfect entry point is one of the most expensive fantasies in finance. It gives the beginner the illusion of prudence. He says, I am not procrastinating. I am waiting for a better valuation. I am waiting for a crash. I am waiting for clarity. I am waiting for the next Fed meeting. I am waiting for inflation to settle. I am waiting for markets to stop being volatile. He sounds thoughtful, but if no written plan exists, he is usually only afraid. A written plan might say, I will invest a fixed amount each month regardless of headlines. If the market falls 20%, I will add more if my emergency fund is intact. If the market rises, I will continue the same habit. If I need money within 5 years, I will not put it in volatile assets. That is a plan. Vague waiting is not a plan. Vague waiting is fear wearing a suit. The ninth mechanism is the simple index engine. Beginners often think investing must be complicated. They see charts, tickers, options, crypto debates, sector rotations, economic forecasts, guru arguments, and complicated language. Then they freeze. They assume they need to understand everything before doing anything. That is not true. For most beginners, a simple, low-cost index fund can be more than enough. It gives exposure to many companies. Instead of forcing the beginner to pick one, it reduces the risk of a single company failing. It keeps fees low. It lets the investor focus on saving, consistency, and time rather than daily prediction. This simplicity is not ignorance. It is intelligent delegation. A broad index says, I do not know which company will win the next decade, so I will own a diversified claim on the productive economy. I will not spend my life trying to outguess professionals who also fail often. I will let the system refresh itself as companies rise and fall. That is a powerful choice. The danger is believing simplicity is too ordinary to work. People want a strategy that sounds brilliant. A boring index fund does not make them feel brilliant. It simply makes them owners. Ownership is enough. The 10th mechanism is the complexity tax. The financial world often makes money by convincing beginners. They need complexity. Complex products, complex trading, complex timing, complex charts, complex strategies, complex predictions. Some complexity has a place for sophisticated investors, large portfolios, tax planning, business ownership, and special situations. But beginners are often harmed by complexity long before they are helped by it. Complexity creates hesitation. Complexity creates fees. Complexity creates overtrading. Complexity creates mistakes. Complexity gives a person a reason to study forever and never invest. A simple plan that is executed for 30 years will beat a brilliant plan that is abandoned after 6 months. The beginner should not ask, what is the cleverest thing I can buy? He should ask, what is the simplest good plan I can stick with through fear, boredom, and temptation? That is how wealth is built. The 11th mechanism is the panic. Sell wound, markets will fall. This is not a possibility. It is a certainty. If you invest for decades, you will see frightening headlines, deep declines, recessions, recoveries, bubbles, crashes, inflation scares, and political fear. A portfolio dropping does not automatically mean the plan is broken. It means the asset you own is priced daily by millions of emotional people. If you sell during panic, you convert volatility into permanent loss. That is the wound. A beginner sees red numbers and thinks the market has taken his money. But a decline is not the same as final loss unless the underlying assets are permanently impaired or the investor sells. If you own a diversified index and your time horizon is long, a decline may be painful, but it can also mean future contributions. Buy more shares. This is the strange emotional training required to become an investor. You must learn to see lower prices as both pain and opportunity. Most people can understand this in a store. If the thing they want goes on sale, they are happy. In the stock market, when future ownership goes on sale, they panic. That is human nature. Your job is not to deny human nature. It is to build a system that protects you from it. Automatic investing helps because it buys when you are scared. The 12th mechanism is the account question. A beginner does not only need to know what to buy, he needs to know where to buy it. The account matters in the United States. That may mean a 401k IRA, Roth IRA, taxable brokerage account, or other vehicle in the United Kingdom. That may mean an ISA pension or general investment account. Other countries have their own wrappers. The details change by law, but the principle is universal. Taxes matter, fees matter, access matters. Employer matches matter, government allowances matter. A tax-advantaged account can make the same investment more powerful because less money leaks away to taxes. A retirement account can encourage long-term discipline. A taxable account can offer flexibility before retirement. The best choice depends on your country, income, time horizon, and goals. The beginner does not need to master the entire tax code before investing, but he should not ignore the wrapper. The wrapper can change the final result. The 13th mechanism is the fee drain. A 1% fee sounds small. It is not small over decades. If compounding is the engine, unnecessary fees are the sand poured into it. A beginner investing $100 a month cannot afford to donate part of the machine to expensive products that do not improve the outcome. Low cost matters, not because the cheapest thing is always best, but because every fee must earn its keep. A broad index fund with a low cost gives more of the return to the owner. A high fee product must overcome its fee before the investor benefits. Many do not. In business, costs matter. In investing, costs compound too. The 14th mechanism is the no-hero plan. You do not need to become a stock-picking hero to build wealth. You do not need to stare at screens. You do not need to predict earnings. You do not need to understand every interest rate speech. You do not need to know what the market will do next month. For many people, the best plan is almost embarrassingly plain. Build the emergency fund, pay off toxic debt, open the right account, choose a diversified low-cost investment, automate a monthly contribution, increase it when income rises. Do not sell during ordinary market panic. Keep going for decades. This plan sounds too simple because it does not flatter the ego. That is why it works. The 15th mechanism is the boredom dividend. Boredom is not the enemy of investing. Boredom is often the proof that the plan is sound. If your wealth plan requires constant drama to feel alive, you may be speculating rather than compounding. The best investments often become background systems. They run while you work, sleep, raise children, improve skills, and live life. The account grows slowly, then faster, then surprisingly, the investor who needs constant excitement interrupts it before the surprising part arrives. That is why financial entertainment can be harmful. It makes ordinary good behavior feel inadequate. It convinces people that if they are not trading, rotating, predicting, reacting, and chasing, they are falling behind. In reality, the person quietly investing every month may be doing the most important thing. The 16th mechanism is the future. Self-contract. When you invest small amounts consistently, you are making a contract with a person you cannot yet see. Future you, that person may be 50, 60, 70, or 80. That person may be tired of work. That person may want options. That person may need medical care. That person may want to help family. That person may want to leave a bad job, start a business, move, rest, or simply sleep without fear. Every month you invest, you sign a little contract with that future person. Every month you spend everything, you break it. This is not about guilt. It is about responsibility across time. The younger self often thinks the future is far away. The older self knows the future arrives quickly. The wealth builder behaves as if the older self has a vote today. The 17th mechanism is the inflation adjustment. $100 a month is a beginning, not a permanent ceiling. Inflation will reduce the purchasing power of money over time. Income may rise, expenses may change. Contributions must grow when life allows. If you keep investing the same small amount for 40 years while everything else rises, the plan may still help, but it will not do what a growing contribution could have done. This is why your investing habit should have an annual review. Can I increase by 5%? Can I raise it after a pay rise? Can I redirect a paid-off debt payment into investments? Can I invest part of a bonus? Can I avoid lifestyle creep long enough to increase the contribution? The account grows by time, return, and contribution. Control the part you can. The 18th mechanism is the independence shift. At first, investing is about money. Later, it becomes about independence. A person with no savings must obey more. A person with a strong emergency fund can breathe. A person with a growing portfolio can think differently. A person whose assets produce meaningful returns has options. A person with enough capital can leave, negotiate, wait, help, refuse, and choose. That is the true meaning of wealth. Not luxury, choice. A100. $1 monthly habit will not create choice tomorrow, but it begins the process. It turns one income stream into a future balance sheet. It turns consumption into ownership. It turns anxiety into action. It turns the worker into an investor. That identity shift matters. The 19th mechanism is the proof of start. A person does not become an investor when the portfolio is large. He becomes an investor when the first automatic contribution is made and left alone. The first contribution proves that he has crossed from intention into action. Most people never make that crossing. They gather information, watch videos, read articles, save posts, ask questions, wait for clarity, and then do nothing. Knowledge that never becomes action is entertainment. The first small transfer is not small. It is evidence. It proves you have stopped waiting for permission. The 20th mechanism is the final mirror. If you can invest only $100 a month, will you begin anyway? If the market falls after you start, will you keep going? If your first 2 years look unimpressive, will you understand that the machine is still young? If your income rises, will you increase contributions before lifestyle captures the raise? If the news is frightening, will you remember that the world has always offered reasons to wait? If investing feels complicated, will you choose simplicity instead of freezing? If future you could speak, would that person ask for more excuses or more ownership? These questions are not complicated. They are honest. You do not need rich parents. You do not need a lottery ticket. You do not need a brilliant business idea. You do not need the perfect economy. You do not need to know the next market move. You need a safety net, a simple account, a low-cost ownership vehicle, an automatic habit, and the temperament to let time work. That is not glamorous advice. It is better than glamorous. It is usable. The world will keep selling urgency. It will tell you the market is too high, then too low, then too uncertain, then too risky, then too late. Ignore most of it. Build your emergency fund. Start small, increase with income, keep costs low, own productive assets. Do not panic sell. Let boredom pay you. The first $100 will not make you rich, but the person who can invest the first $100 consistently has become the kind of person who can eventually manage far more. Wealth begins as a number, then it becomes a habit, then it becomes a machine. Then, if you give it enough time, it becomes freedom.